The silver price on the COMEX right now is $65 or $74. The AG T+D benchmark on the Shanghai Gold Exchange is printing 69.66, a 392 gap. Curious that number feels modest on first reading. By the time this video is over, you'll understand why it's the most important number in the precious metals market today, what's preventing arbitrage from closing it, and why 3 things happening in the next 72 hours will tell you whether the Western paper price is about to follow Shanghai upward or stay stranded behind it. Let's start with the gap itself, because most people misread it. The mainstream explanation goes like this. Shanghai runs a physical delivery system, Chinese industrial demand is elevated, the yuan has quirks that complicate cross-border arbitrage, so sometimes Shanghai trades a few dollars above COMEX. Normal, explainable, move on. Except the arbitrage mechanism that's supposed to close this gap isn't closing it. An ounce of silver weighs the same in New York as it does in Shanghai. Shipping costs are approximately $1 to $2 per ounce. The gap today is 390 taus. On paper, a trader buys COMEX silver at 65.74, ships it to Shanghai, sells at 69.66, and pockets somewhere between 190 and 290 per ounce. A riskless trade. It should have closed before you woke up this morning. It hasn't. That's not a pricing anomaly. That's a physical supply problem. Right now, according to the COMEX Physical Supply Monitor tracking CME Group's daily vault data, registered silver, the only category of metal that can actually be delivered against a futures contract, has declined 14.1% in the last 30 days alone. That's 13 million ounces withdrawn from the deliverable pool in a single month. The coverage ratio, which measures what percentage of outstanding paper claims could be satisfied by the registered inventory backing them, stands at 14.2%. Below 15% is what the exchange itself classifies as stress territory. You are looking at a market that is, by its own institutional definition, in stress. Paper leverage sits at 7 times. That means there are 7 paper claims outstanding against every ounce of silver in the deliverable vault. And April's first notice day is 7 business days away, with 119.27 contracts, 9.6 million ounces of delivery demand, still open. Here's the mathematical tension you need to hold in your head. COMEX registered silver has fallen from 240 million ounces in April 2020 to approximately 78 million ounces as of this week. That's a 67% depletion of the exchange's entire deliverable buffer in under 6 years. The total paper claims outstanding against that pool remain at multiples of what physically exists. Someone in Shanghai is paying 69.66 for the same ounce of metal that COMEX says is worth $65.74. The arbitrage isn't closing. The vaults are draining. And April 1st notice day is 1 week away. These facts are not being connected on Bloomberg or Reuters. By the end of this video, you'll see exactly why they're connected, what the connecting mechanism is, and what you should watch in the next 72 hours to know how this resolves. To understand how this gap was manufactured and why it's structurally different from any premium that came before it, you need to know what changed on January 1st, 2026. On that date, China, which the Silver Institute's data identifies as accounting for more than half of global refined silver production, implemented strict export licensing controls on silver. Beginning this year, only firms with significant production capacity and state-approved credit lines qualify for export licenses. Smaller and mid-sized exporters are sidelined by design. This single regulatory change, documented in official Chinese policy filings, severed the traditional arbitrage route between Shanghai and Western markets. It is no longer possible for a Western trader to simply purchase COMEX futures, stand for delivery, take a 1,000-ounce bar off a New York vault shelf, and ship it east. The metal can move from west to east only if someone on the western side is willing to part with it at a sufficient premium, and the bar that leaves a COMEX-registered vault reduces the already thin coverage ratio by another 5,000 ounces. That is the hidden mechanism behind the 3.92 gap. The premium is not a trading inefficiency. It is the price of a broken arbitrage route. The market is quoting 2 prices for the same metal because the 2 systems, one physical and one primarily paper, have been structurally disconnected by a policy action that Western financial media has almost entirely failed to incorporate into its price analysis. The data underneath this story is extraordinary in its consistency. According to analysis published by Real Clear Markets on March 17, 2026, all of 2025 combined settled 474 million ounces of physical silver at COMEX, more than double the 203 million ounces settled in 2024. That doubling happened without a headline event that most people could name. In December 2025, 65 million ounces were delivered in a single month record. January 2026 followed with 49.4 million ounces, which the data shows was more than 7 times what January 2024 had generated. February 2026 then delivered 25.18 million ounces, the highest February delivery volume in modern COMEX history. When first notice day for the March contract arrived on February 27th, 10,526 contracts stood for delivery. representing 52.63 million ounces, against registered inventory that the CME's own vault data showed at 86.13 million ounces at that moment. That is 60.9% of the entire deliverable pool standing for delivery in a single contract month. To put that number in context, the normal percentage of open interest that stands for delivery in any given contract month ranges from 5% to 20%. The March figure vastly exceeded that. It was closer to 100% of the front month open interest standing rather than rolling, in a pattern that the CME Group's own warehouse reporting has not seen in its recorded history. Market participants were not rolling contracts forward, they were taking metal. That behavioral shift from paper holder to physical holder is not noise, it is the signal. The detail that almost nobody in mainstream financial media picked up from the February data is this. On January 29, 2026, first notice day for February delivery, 1,981 contracts stood for delivery on a single day, representing 37.3% of everything that would be delivered in the entire February cycle. Industrial users and institutional accounts were not waiting. They were not spreading their demand across the month. They secured their metal on day one as early as the rules of the exchange permitted them to do. When buyers of physical metal refuse to wait a single extra day to take delivery, that is not a statement about profit maximization. That is a statement about confidence in availability. The London Bullion Market Association, which sets the global spot benchmark and administers the good delivery standard for silver bars, has its own story running parallel to the COMEX data. By early 2026, LBMA-eligible silver stocks had contracted to approximately 155 million ounces. The 3-month silver lease rate, which in a well-supplied market typically sits below 0.5%, spiked to 8% by January 2026 and had reached as high as 34.9% on an intraday basis in October 2025, according to data from the Japan Bullion Market Association. Think about what a lease rate of 8% means in practical terms. When an institution borrows silver, it pays that rate as the cost of securing a deliverable bar instead of a paper claim. An institution does not pay 8% annualized to borrow something it could get easily and cheaply elsewhere. It pays 8% because it has no other option. The lease rate is the market's stress test made visible. Now consider what is happening simultaneously on the Federal Reserve's side of this equation. On March 18, 2026, the Federal Open Market Committee voted 11-1 to hold the benchmark federal funds rate unchanged in the range of 3.5% to 3.75%. The Fed's post-meeting statement specifically cited developments in the Middle East as introducing elevated uncertainty into the economic outlook. This is the context. The United States and Israel are conducting active military operations against Iran. Oil prices have surged approximately 0.92 per gallon of gasoline at the pump in the 30 days preceding the March 18th decision, according to AAA daily tracking data cited at the Fed press conference. Jerome Powell said plainly, "Nobody knows the full economic effect of the conflict." His term as chair ends May 15th. This is where this story becomes what it actually is, a collision between monetary policy paralysis, geopolitical commodity disruption, and a structural fracture in the physical silver supply chain, all hitting simultaneously in the same 6-week window as the COMEX vault approaches the thinnest deliverable buffer it has ever carried. This brings us to the historical parallel that illuminates why this moment is different. In March of 1980, the Commodity Exchange responded to the Hunt brothers' accumulation of silver by implementing Silver Rule 7, which imposed heavy restrictions on buying with debt. The restriction ended the squeeze, and the price collapsed from its 49.45 peak. The mechanism the exchange used was leverage restriction. Make it prohibitively expensive to hold a long position financed on margin, and the positions liquidate. The 2022 London Metal Exchange nickel halt offers a different but related case. When nickel prices surged beyond what short sellers could cover, the LME halted trading and canceled executed trades, retroactively after settlement, to prevent a cascade of institutional failures. Neither of those interventions addressed the physical supply picture. They addressed the paper pricing mechanism. The 2026 situation is structurally different from both precedents in one critical way. In 1980, the Hunt brothers were the demand. Remove them, and the artificial demand disappears. In 2022, at the LME, the squeeze was driven by one concentrated short position. Remove that position, and the market rebalances. In 2026, the demand standing for delivery at COMEX is not concentrated. The Real Clear Markets analysis from March 17th states that the entities standing for delivery are almost by definition not industrial users who procure through offtake agreements. They are institutional accounts, funds, and entities that hold futures contracts and are choosing physical over paper at rates the exchange has never processed. The demand is distributed. You cannot cancel a rule that targets one participant. You cannot retroactively freeze a delivery obligation when the claimants are dispersed across hundreds of accounts. You can print contracts. You cannot print the metal itself. That sentence captures the entire structural argument in 9 words. The paper claims are not supported by the metal that is being withdrawn from the vaults to meet them, and the entity that produces China's refined silver has now restricted its export. The arbitrage that was supposed to replenish Western vaults is severed. iShares Silver Trust, the largest silver ETF trading under the ticker SLV, saw its price drop to $61.52 as of today, March 23rd, with a previous close of $65.68. That is a one-day move of roughly 6.3%. But here is the context SLV investors need. Over the prior 12 months, SLV's net flows have been positive $1.01 billion, money coming in, not going out. The one-month flows show $1.43 billion leaving as prices drop, which is the behavior of leveraged momentum players being flushed out, not long-term physical holders reducing their exposure. The physical holders are staying in, the fast money is leaving. These are different populations with different behavior, and conflating them produces the wrong conclusion. Now let's address the strongest version of the bearish case, because it deserves a full hearing. The counterargument runs as follows. COMEX has navigated apparent inventory stress before and has never formally defaulted. The exchange has multiple tools at its disposal. Margin increases that force leveraged longs to liquidate, cash settlement provisions, eligible to registered conversion of the 440 million ounce total inventory, and exchange for physical arrangements that reroute delivery outside the formal warrant system. The 14.2% coverage ratio looks alarming, but in practice, the exchange argues that the conversion buffer, the eligible inventory that can technically be moved to registered status within 24 to 48 hours, expands the effective delivery capacity well beyond the headline registered figure. Furthermore, the bearish case notes that silver dropped from an all-time high of 121.67 on January 29, 2026 to approximately 65.74 today, a decline of more than 45%, suggesting that the structural bull case, however logically constructed, has not prevented a devastating drawdown for silver holders in the near term. Speculative positioning collapsed 77.72% year-over-year by February 2026, from 54,415 managed money contracts to just 12,121, according to COMEX data. The momentum trade unwound and the price followed. Here's what that counter-argument misses, and what the data from this specific week changes. First, the eligible to registered conversion argument assumes that the owners of eligible silver are willing to make that conversion at current prices. They are not. The pace of withdrawal indicates the opposite. Owners of eligible silver are pulling metal out, not converting it in. The incentive structure is reversed. Second, the bearish argument treats COMEX registered inventory as the only relevant signal and ignores the Shanghai premium as a simultaneous data point. If the arbitrage were truly functional, if metal could move freely between the two systems, the premium would close. It has not closed. That is the data point the bear case cannot explain. Third, and most importantly, the April 1st notice day is 7 business days away. The pattern from the last 3 delivery cycles, January's 49.4 million ounces, February's 25.18 million, March's 52.63 million at first notice, shows that delivery demand is not declining as the registered buffer shrinks. If anything, the data suggests front-running of the April cycle is already embedded in current open interest. Markets can defy logic for longer than expected. Price can detach from fundamentals in both directions. The $45 drop from the January high is real, and dismissing it as noise would be dishonest. Anyone watching this market needs to carry genuine uncertainty about the timing and direction of the next move. What the data makes structurally difficult to dismiss is the combination: draining vaults, severed arbitrage, lease rates at multi-year highs, a Federal Reserve that can neither cut nor hike without risking stagflation, and a geopolitical energy shock that has removed one of the Fed's traditional pressure release valves. Here are 3 specific, verifiable things to watch over the next 72 hours, with exact sources you can check yourself. The first is the CME Group Daily Vault Report, published each business day after market close, accessible on the CME Group website under Metals Delivery Reports. Watch registered silver specifically, not total inventory. If registered inventory drops through 75 million ounces this week, the April delivery math becomes significantly more constrained. The report typically posts between 3:30 p.m. and 6 p.m. Eastern. The second watch point is the SLV share count, updated daily on the iShares website. The share count is a direct proxy for the physical ounces held in trust. If shares outstanding begin declining sharply, more than 3% in a week, it indicates redemption pressure, meaning authorized participants are pulling metal out of the trust. That would be directionally consistent with the vault drain. If the share count holds or grows as price drops, the physical holders are absorbing the selling, which is the opposite signal. The third watch point is the Shanghai Ag TPSD settlement price on the Shanghai Gold Exchange, published nightly Beijing time. If the premium to COMEX widens beyond 5 Ozurs from today's 390 talis, it means the arbitrage blockage is intensifying, not easing. If the premium narrows toward $1 or below, it means metal is flowing, and the structural argument has a shorter timeline than the data currently suggests. What the evidence assembled today: the 7 times paper leverage against a 14.2% coverage ratio, the 392 Shanghai premium that cannot be arbitraged away, the broken supply chain from China's export controls, the Fed paralyzed by competing stagflationary pressures, and the April 1st notice day now 1 week out. What all of that adds up to is not a prediction. It is a structural description of a market in which the two sides of the price equation, paper claims and real metal, have never been further apart while simultaneously being closer to a forced reckoning through delivery mechanics. The paper price and the physical price are telling two different stories. For 15 consecutive months of delivery acceleration, the physical market has been voting. It has been voting with delivery notices rather than rollovers, with metal withdrawals rather than deposits, with Shanghai premiums that remain open rather than close. The COMEX price on your screen today at 65.74 and the Shanghai physical settlement at 69.66 are not two prices for the same thing. They are two prices for two different levels of certainty about receiving the metal. The first is a promise, the second is a bar in a vault. The question for the comment section today is specific. Given that COMEX registered silver has declined 14.1% in the past 30 days and stands at a 14.2% coverage ratio with April 1st notice day 7 business days away, what do you think the registered inventory number will be when April delivery is complete? Put your figure in ounces in the comments. I'll pin the most precise analysis once the CME reports confirm the final April delivery volume. April 1st notice day falls this coming Wednesday for early movers, with the formal delivery window opening at month end. I'll have the analysis up the night before. If you're not subscribed with notifications on, you will miss the data when it actually matters. Everything in this video is sourced from public data: CME Group vault reports, LBMA documentation, Federal Reserve post-meeting statements, Real Clear Markets delivery analysis from March 17, 2026, and Shanghai Gold Exchange benchmark pricing, all linked in the description. I'm not a financial advisor, and nothing here is investment advice. Verify every number yourself before making any decision. The links are there. Do your own research.